All right. Welcome to this free info session. We're going to talk about how you can invest in real estate or help your clients invest in real estate without income or employment verification. Now, that's personal income or employment verification, and we'll get into more of the nitty-gritty of what we mean by that. But we're going to be talking about how you can use DSCR loans to grow or start your real estate investment portfolio. And the agenda is as follows. We'll talk about what is DSCR. Okay. We'll talk about the pillars, the three pillars for qualifying for a DSCR loan. We'll talk about and give real world examples of use cases of DSCR folks that we are shopping, clients we're shopping for DSCR options for, and what those different examples are. And time permitting, we'll also we're going to log into my MLS and see if we can find a property or properties that might qualify for DSCR loan and might make a great investment opportunity, and how you can do the same if you're a real estate agent to proactively create transaction opportunities for yourself or your past clients or just your social media sphere of influence, etc. So, Jordan, DSCR stands for what?
Debt service coverage ratio. And what does that mean?
Right. That was my next question.
Debt service coverage ratio is, to explain it in layman's terms, is it's basically the income from the property, the income generated from the property, aka rent, whatever it's renting for, or projected rent, covers the debt, the PITI. So as long as the traditional DSCR is a 1-to-1 ratio. So, for example, if our projected rent is $1,400, as long as our mortgage is $1,400 or less, then you would qualify, pursuant some other qualifications. Income-wise, that's the only income required to purchase that property. So there won't be any income taken or derived from any other sources, such as, W-2 or
1099,
bank statements, anything, self-employment. So this makes it very easy for self-employment people and investors to be able to write off their taxes, still buy property, because it's mainly based off the property and what the property is income producing.
Two ways or two possible ways that the income of the property is verified. Number one is if you have a lease agreement, right? So if you can prove what a tenant is paying right now. And option two, Jordan, is called what?
A 1007.
Yes.
A lot of times they'll do, if there is a lease agreement too, some lenders will ask for both if there's a lease agreement already in place. But for example, for purchases, there's not going to be a lease, in place unless it's already being rented. And you might not rent it for that amount, right? So there is a 1007, which an appraiser, it's a form that an appraiser will fill out. So when the appraisal is completed on the property, determine the value of the property, they will also fill out a 1007, which is basically just a rent analysis for that area, for that property, of how much the projected rent would be for it.
Exactly.
So on purchases, a lease is not necessarily required. Just a 1007 is, at that point.
Okay, so we have that's one of the three pillars, right? We're verifying the income potential of the property, or not just the income potential. It might be the actual income from the property currently. That's pillar number one. We don't have to verify income. We don't have to have W-2. We don't have to have 1099. We don't bank statements, P&L, none of that. The income from the property. That's pillar one. What are the other two pillars? If I'm an investor and I want to use a DSCR loan to buy a new property or cash out refi or rate and term refi, etc.
I like to explain that in all mortgages, there are really three pillars to an application, right? Credit, income, assets. And we talked a little bit about income on this particular property, which is the DSCR.
Yep.
Credit is the next pillar that we look at. DSCR loans, it's going to depend on how much money that you're putting down, right? It's a give and take. Think about it as like a little bit of a tug of war. There are a lot of lenders out there that have the typical minimal credit score is 620, but they go as low as 575. But
so hold on. Yeah. So we have a few lenders that will go as low as 575 for a DSCR. 620 is more the norm. And then where do we find that?
It's more than norm. It's more than norm as the minimum, right?
As the minimum, right. I'm sorry. So we have a few that are 575. More normal minimum of 620. Where do we find where's the cutoff where the pricing and the terms, et cetera, tend to get considerably better?
About 660.
Okay.
Credit score. So you'll start seeing people get a little more competitive with down payment. It's a give and take. Right. So where if we're doing a 575, we're going to need 35% down, right? With X amount of dollars in reserves. It's going to have more stringent terms on the other pillar, on the other pillars, or a higher DSCR ratio, right? The loan itself has to make sense, right? Sure. It has to make sense to the bank. So really the 660 is where you're going to see, 25% down, 20% down on purchases, 70% loan to values on 70 to 75% loan to values on cash out refinances. But for the most part, to get it through, it's 640 to 660 we could get it done pretty easily.
Okay, so we have the income of the property, we have the credit score, and then tied to that, depending on the credit, is going to that will affect how much down payment or how much what LTV, if it's a cash out refi or even a rate and term refi, what LTV is going to be in play for the borrower.
Yes. I like to explain to people it comes in tiers, right? Tiers of 20. 620. You notice there's like 620, 640, 660. I mentioned certain tiers. That's because they list them out in tiers. Every 20 basis, 20 credit score points more, typically another 5% reduction in the down payment is allowed. So with that being said, the maximum, or I guess the minimum down allowed is 15%. Right. That is going to be a 720 plus credit score typically. But with that being said, doesn't mean that they're not going to have worse pricing with 15% down, right? Rates could be a little bit higher with that amount of money down. Really, the sweet spot is going to be about 20%, which is for the norm for most investment properties.
To reiterate, it is possible to purchase or acquire with a DSCR loan with as little as 15% down. You're going to have to, the borrower is going to have a higher credit score, and there are other factors involved there. And also the pricing may not be as strong, and really it's not going to be as strong as if you were going to, do 20 or 25%. Right. And so possible, but it may not be in the client's best interest. And it also affects the ability to get that 1-to-1 ratio, that 1-to-1 credit ratio. And
the payment's higher, everything is higher, right? So that DSCR ratio, it comes into play on the DSCR. Not that we can't go less than 1-to-1, right? It's a little bit of a side note. But the 1-to-1 itself is going to be the norm that you have. But with that being said, doesn't mean we can't go less than that. There are lenders, the normal lenders that will go less than that will go down to a 0.75. Anything less than 0.75, there's another product called a no ratio DSCR loan. That's a completely different product with different terms. But it essentially is they won't even take lease or their 1007 into account at all. And then pricing on that is significantly worse because they're taking one pillar away. Essentially, it's a no income loan altogether. And back to the assets real quick. I don't want us to forget about it. There are another part of assets that you need when you're buying a DSCR loan, and it is reserves. Okay.
Yeah.
Same with like the 1-to-1 ratio. If we have a proposed mortgage payment of $1,400 and the rent has to be $1,400, there also has to be a certain number of reserves. The normal amount of reserves that is needed to purchase with a DSCR loan is 6 months. They want you to be able to, for you to operate for a while. And a lot of that, the concept there is that they want you to be able to find a renter, have plenty of time to find a renter. Maybe you're going to fix up the property a little bit, do whatever you need to do. But it gives you plenty of running room, essentially, to get you going. There are
and not just a renter though, Jordan. It's find a quality renter, right?
Yeah.
So there's not like this sense of they don't want folks that are panicking to put just anyone in the property.
Yes,
because of X or Y or Z.
Yeah, it's a lot harder to get them out once they're in. So, with that being said, there are instances, again, where there are lenders that will not require 6 months reserves. There are lenders that require 3 months or 0 months. It depends on credit score, depends on down payment. There are a lot of lenders with 25 to 30% down. They'll waive the reserve requirements altogether. As well as if you're doing a cash out, right? You're obviously doing cash out. They're not going to require you to have reserves at that point. They do require it, quote unquote, but the cash out itself is used as reserves. So we have a lot of people that will do the BRRRR strategy, in a sense, and people don't know what that is. It's buy, rent. What is it? Buy, rehab,
rent,
and repeat,
refinance,
and something like that.
And
it's a lot of R's.
Yeah,
it's a lot of R's.
Repeat. It's buy, renovate, rent, refinance, repeat. That's what it is.
BRRRR strategies. So basically, people will go in and buy these properties. They'll fix them up and they'll rent them out. And then we'll turn around and we will cash those out to get their money back out of it, because now we have after renovation value. And we'll cash those properties out, give them the investor all the money back. They have the renter in there covering that payment, that new payment. And then they have enough money to go out and buy another property or reinvest their money again, right? If they get the majority of it back. And they just keep on doing that, acquiring property and let someone pay that mortgage down.
Before we pivot to some example use cases, if you have an investment property yourself, or you're thinking about buying an investment property, or you have a client and you want to, you'd like us to shop for the best DSCR options for them. It's scrolling across the bottom, depending on where you're watching this. You can go to joshvips.com/DSCR, joshvips.com/DSCR. And if you're watching the video, you can also scan the QR code top right, although I got to get rid of this guy here. Now, that said, that's just a Google form. You fill out some basic information, and then our team will go and shop, because we literally have, how many are on our DSCR matrix at this point, Jordan?
I don't know, 60.
Yeah. So we have a whole bunch of different options that we will then go and shop and find the best deal for folks. We do have a question from a Facebook user. Could I use my S Corp to buy with these types of loans?
Yeah, you can use business entities. Sometimes there's a hit on rate. So it's very common to use LLCs and other entities, but sometimes those lenders will take like a 0.25% hit on pricing. So let's say you were pricing a loan and it was a 1 point buy down, it'd be 1.25 buy down, right? For that rate. So you got to be careful who you use. So we develop matrices for us when we're shopping this to have those notes. So when we're shopping it, we take those things into account.
Yep. All right. So some use cases. So like, what would be an example that someone would use a DSCR loan? The first and most obvious is to acquire an investment property, a single family residential. It can be 2 unit, 3 unit, 4 unit. We have DSCR options for more than 4 units. We even have some DSCR options for mixed use properties. So it's really, any sort of configuration of that to acquire a property. Now, the type of property,
apartment complexes, blanket loans, apartment complexes, blanket loans.
Yep.
I mean, there's a ton of if we're just talking about types of properties, there's a ton of reasons to do DSCR loans. Anything you can invest in and make money off of is really what it comes down to. Is you can look at a DSCR loan.
The property type will have an impact on which of the lenders on our matrix are going to be available, and can have an effect on the minimum down payment and some of the other factors, the ratios, things of that nature.
Yeah, it's like a puzzle.
So the obvious one is to acquire a new property. Example 2 use case would be to refinance an existing investment property. Jordan, go ahead.
Correct. Yeah. Refinancing existing property. Maybe I'll give you an example. Maybe you already had a loan. Maybe it was a hard money loan and you took that out to buy a property and renovate it, right? Or maybe you had a property existing and you took a hard money loan to renovate it. Those are instances that you could refinance or rate and term refinance those DSCR and get you into more of a low, less costing. I mean, we just quoted one the other day, had a hard money loan of 10%, right? Right. That was interest only, 10% of interest only. We're going to be a little bit lower than that. It's 30 years. Those hard money loans are usually for a year, right? Depends on the term, the length. Maybe they're getting out of it. Maybe they want to move to a short arm, or maybe it's a 30-year fixed. It just depends. But getting out of loans and refinancing the current existing, maybe they need the equity to pay off all their debt, right? That is an acceptable reason too. We had a borrower just the other day that they wanted to cash out or do a second mortgage. Ideally, they want to do a second mortgage for a couple $100,000 on a property to turn around and pay off all their debt. They don't want to touch the first because of the first was at an aggressive rate, and they already moved it to an investment property. This was originally a primary residence, and they just wanted to get a second so they could pay off all their cars and whatever else they had, and that's easily obtainable. So that's another reason.
So hold on. So we can use it to acquire. We can do a rate and term refi. We can do a cash out refi. What would some other, use cases be? You kind of hit on one that sort of ties into that.
Use cases overall would be. It depends on what your strategy is, really. At the end of the day, I've seen people do DSCRs for short-term rentals and start Airbnb businesses, right? So, overall, in general, it's just going to be purchase, rate and term, cash out. But what are you trying to use the loan for, such as like a short-term rental or a long-term rental? Those are all things that play a little bit of a factor on your LTV or some of the requirements, but it's all doable, right? I've had people come to me and say, Jordan, I want to start an Airbnb business with the right assets and the right credit score. Absolutely. You can do it with a DSCR loan without having a history of being able to, of doing those. Typically they do want to see a short, not to get off on a tangent on short-term rentals with DSCRs, but typically they do want to see some sort of management experience of 1 year of doing that, maybe a little Airbnb arbitrage or management company experience.
So acquisition, okay, to purchase, rate and term refi, cash out refi, and we do, not many, but we do have DSCR second mortgage options.
Oh yeah,
right?
Yeah.
Not many, but we do have some of those.
As well as blanket. That's a big one. That's one that's coming back.
Yes.
Blanket loans, blanket DSCR loans. So if you have a package of 10 properties, right, and you're trying to maybe they're a lower loan amount. You're right, where some DSCR loans won't fit the box. Most DSCR loans will have a minimum of about $100,000. Yeah. The norm is like you have to have a loan amount of $100,000. So there are some properties, and I'm from the Midwest in Kansas, so there's some properties here that don't meet that minimum. And sometimes people will blanket a few of them together and cash those out so they can they open themselves up to a few lenders.
For example, we got one that came in this weekend. They have 7 rental properties. They own them all free and clear, and they're looking for a blanket DSCR loan option so that they can pull some equity out and put that equity back to work to grow their portfolio, right? That's a wonderful example or use case.
One set of closing
of
costs instead of 5, right? I think they gave us 6 properties, but
Yep.
one set of closing costs instead of doing 6 individual loans.
Yep.
So on and so forth, right?
Yep. So we have the different, we have the pillars, right? What is DSCR? We have the pillars. We have some different use cases. We talked about guidelines, et cetera. I think now would be a good time to pivot to, if I'm a real estate agent or even a loan officer, and I want to strategically use these, well,
or just make content. Let's just say, hey, or maybe I just want to make content, right?
Yeah.
Putting yourself out there, especially on social media for these types of loans, or maybe you want to create a database of investors, right? At the end of the day, and send out to investors. I've seen people reverse engineer this. And I think that's where you're going with this, right, Josh? Is your
exactly
reverse engineering? I've seen people reverse engineering near this, where they will create Facebook posts of specific properties and kind of give a scenario of what an investor could do, and they send it out to a group of investors.
Well, so let's think about the opposite side of this, right? So as real estate agents or LOs, most often we're waiting for the client to come to us.
Yes.
This is a way that you can strategically bring, put together deals and use them to get the clients to come to you. You can be more proactive and reverse engineer the process to get people to raise their hand that may not have otherwise reached out to you. They might have been thinking about buying an investment property, but when you present a scenario to them, they may or may not be interested in that one, but it opens up a communication or a conversation where you can then, maybe they have another property. They've been negotiating with their neighbor or their buddy to buy an investment property, but they didn't know how to make it work. They didn't know if they would qualify, et cetera, right? It creates a conversation. So I thought, let's take maybe 10, 15 minutes and actually do this, right? I'm gonna go into my MLS.
My first objection when I have people, just a kind of a side note, is that it's the legality of posting something like this. These are commercial loans for the most part. Most states consider them commercial loans, and you can ask one of us and we'll get you a list. There's a list of commercial loans, and these do not fall under normal rules at all. So for example, do not have to be licensed in probably 20 states and still be able to originate these. So no, you don't necessarily need a license with them. It depends on your state.
And also, I think when you present something like this, I would present the idea and not and disclose that the numbers shared here are for illustration purposes only, right? So be transparent that it's not a guarantee of cash flow or return on investment or anything like that, but just to illustrate what's possible, let's say. So I'm in my MLS. I just pulled up. I'm in central Pennsylvania, Harrisburg, Mechanicsburg, Carlisle area. I pulled up. I'm going to search Carlisle, and I'm going to search just a price range of 175 to 260, because I know in my market, in that price range, there is, at least a somewhat better opportunity to make the numbers work from a cash flow perspective. And I'm going to pick one here that I've actually been kicking around for myself anyway, which is there are some new construction townhomes, 3-bed, 2.5 bath with a garage, no basement, but that's okay. Typically in Central PA, we have basements, but if this was a rental property, that wouldn't be the worst thing in the world. And so I'm curious, Jordan, how would you approach from the LO perspective? How would you approach determining would this pencil, quote unquote, for a DSCR loan?
3 pillars. Number one, we're going to assume we got like a 680 credit score. So we qualify for 99% of banks out there at 20%. Okay. So that's pillar number one. So that's first is what's the buyer's credit score, which we don't really know when we're putting something like this together. So we're going to assume it's a 680, somewhere around there, 660. Number two is assets. Okay. That is going to be
down.
It's going to be 20% down. Okay. So,
which, by the way, this brings up a really good point, Jordan. I've got to have 20% down, but what if I can negotiate with the builder here to pay some closing costs? Is that how does that?
Yeah, most we call them IBCs, right? Interested buyer concessions, or seller concessions. Most places are not going to even mention what they can provide. It's more than a Fannie Mae and Freddie Mac allow on traditional investment properties. Okay,
so I could theoretically ask for 6% seller help.
Yes,
and it
we have lenders. I can guarantee for a fact that we have lenders that allow up to 6%. So you could ask for 6% in seller help. Use the difference to buy down your rate further, whatever you wanted to do, but you can get seller concessions.
So let's assume we've got a 680 borrower, we've got 20% down, and let's assume that we can get 5% seller help or 6%. And that doesn't really matter a whole lot. What else do we need to verify? Would this make sense? A, and if not, just for exercise purposes, at what price would it make sense? At what price would it pencil or cash?
Back to assets. Okay.
Yep.
We want to line out credit. We line out credit at 680. Right. We're good. Right. We've lined that. That's pretty quick to line out. We find out very quickly. Right. Number two is going to be assets. It's 20% down. We're going to need reserves. Okay. So it's 20% down in reserves. We might be getting 5% in seller help, which would cover our closing costs. So that would be all what we needed. The reserves are going to be based off the mortgage, which we're going to calculate here in a minute. So that's going to go into our assets. And the next one is going to be, what do we think this property will rent for? I'm not from the area. So what do you think it would be?
Well, let's do this first. Let's figure out what it would need to rent for.
Okay.
To make it be a minimum of 1-to-1 ratio.
So I'm going to run a mortgage calculator real quick. While you're doing that, do you know what the taxes on this property are?
I was trying to find that. They would be projected because it is new. I'm not seeing it here. I might have to find one that's closed. Taxes
what's the purchase?
All right, so let me see here if I can find one that has settled that would have the projected taxes on it. If not, we'll just have to use a number, and then that would be part of the our vetting process.
If on this instance, if we're using, just so you know, if let's say we can't find the taxes, if we go to the county and get the mill levy, there is a calculation that you can mill levy it out.
Right.
Yeah. But this is going to probably be quicker, finding one that closes and to get the tax amount. What was the purchase price, Josh? Do you know?
So let's just say that we're not able to negotiate the price, but we are able to get the 5 or 6%. So let's just go with a full 250,000.
All right, so 20% down. So our down payment's going to be $50,000.
Yep.
Okay. So that means our loan amount is going to be $200,000. I'm going to say typically we don't have a top tier credit score. We don't have a bottom tier credit score, but I'm going to say we're a high 8% on our interest rate. Okay.
And I'm going to hunt one more place to see if I can find tax information, and if not, we'll just use an estimated number. We'll just use a round number as a guesstimate.
What do you think insurance would be on this property? $100?
I'm gonna say.
I would think it's more than 100, but
yeah, I'm thinking $1,200 a month. Yeah, or $1,200 a year, $100 a month.
Okay.
There is HOA fee of $180 annually. Okay. So that's $15 a month.
Okay.
And just to keep it moving along here, just throw in $3,000 for the yearly taxes. And if I can find something to verify that,
that's fine. We can run with it. It'll give us the same. Okay. So I'm going to break this up into four what I would call it's called PITI, right?
Yep.
It's principal, interest, taxes, insurance, and HOI if applicable.
Yep.
Okay. Sorry, I'm in a hotel, so if it's that glare is coming on the window now, I apologize.
All good. All
good. $250 for taxes, $100 for insurance, $15 for HOA, and then at a higher interest rate in the 8s, it'd be $1,591.29. So a total payment of $1,941.29.
So the total PITIH HOA in this is what number again?
$1,941.29.
1941.29. So we need to get to a 1-to-1. We got to be at least $1,950 per month. Now,
correct.
How do you determine that? Well, one, there are a couple of different ways that you could determine, or estimate the rent. A very quick and easy way is Zillow has a rental estimator tool. I hate Zillow just as much as all of you, but this is a valuable tool and it's free. Zillow.com/rental-price-my-rental. Or if you just Google Zillow rental price estimator, I'm sure it'll come up there. Now, with these being new construction, I don't know if they'll come up, but we'll try it. 4 Parkview Drive. It is coming up. I don't know if the estimate will be accurate or not, but at least it gives us some idea. So it's unable to find it. Okay. Well, if I just want to pop in one that I know will come up. So let me go in here and let's find. I'm going to go back and find. Actually, let's do this instead. I'm actually going to pull up. You can, if you have MLS access, you can pull up the closed rental prices. Okay, so I could go in here and I can pop in Carlisle, PA, and I'm going to say 3-bedroom, total baths 3, and I'm going to put that it's got a 1-car garage. Oh, I'm actually not going to include that. None of the 8 that populated has a 1-car garage. So these are all active. That's what I'm competing against. But let's do the closed. Let's do the closed to see what places actually rented for. So we're getting anywhere from the high end, $25,550, which that seems like an outlier. Okay, so I'm not going to go ahead and base it on that. And then I've got some 2000s, 2100, 2050. So, I mean, I think we'd probably be okay, but I don't know that we want to be okay, right? We want to find properties that would get an investor excited and not just get that 1-to-1. So what you could do is break this down and say, you could do a rental breakdown and say, this really doesn't make sense unless you can get it for 2.25 instead of 250. Right.
You also have to keep in mind is a lot of rent hasn't adjusted where the rates went up real quick, and as they're falling, it will get better. It's going to get better over time. So keep that in mind too. A lot of investors I have are doing 1-to-1s, and then as rates drop, their cash flow increases. Yeah, right. They're still buying. But just to kind of finish out our conversation is okay. We've now established that we can get 1-to-1. We have the credit score, we have the income. And last would be the reserves and cash out. If we're putting 20% down, it costs $50,000, and then you would need at least 6 months reserves at minimum. So $1,941.29 times 6 months in the bank. So they would need about $62,000. $62,000 would get them into this home. And just
to confirm, he's not saying 62,000 reserves, 50,000 for the down payment.
Yes.
plus 12,000 for the 6 months reserve. The 6
Yeah,
times
that money that doesn't go
12,000.
anywhere. It's not spent. It doesn't go anywhere. They just need an additional 12 grand in a bank account. Could be in a 401k. Could be in a lot of places.
Well, that's what I was just going to say. So, what are the different ways that they could verify reserves besides just in a checking or savings account?
Anything that could be liquidated. So stocks, 401ks, checking accounts,
Cash value of a life insurance policy.
cash value, anything that can be liquidated. Really, at the end of the day. So
exactly.
It doesn't have to necessarily be liquidated. You just need the terms of withdrawal, and a lot of times, it's a 60% face value of whatever we're doing.
Yep. All right. So let's bring this bird in for a landing. So here's some ways that you can take this information and put it into practice. Okay. Number one, you can do the exercise that we just did. You can find a mortgage calculator on your own and figure out those numbers. Or you can reach out to Jordan or I, and we can walk you through that on a specific property. Maybe you're looking at a property for yourself or for a client, and you want to know, does this pencil? Does this make work? Does this make sense, rather? And we'd be happy to do that. Maybe you want to, like I am doing in honestly 25 minutes, maybe you'd like one of us to come on and do a session like this for your audience on whatever, on live stream,
Facebook,
for you to share with your database, etc., where we can talk about these types of loans. Or the topic for the one I'm doing at 2:00 is our HELOC programs, which could be a great way for folks to get the cash or the assets or the capital to do a DSCR loan, right? So they work very well in tandem. If that's something you're interested in, please just let us know. Or if you have a property that you want to explore a refi, a DSCR refi, you can scan the QR code. I can't get rid of this dang. Remove from stage, full screen layout. I don't know. There we go. Nope, not that.
Have you tried? Are you trying to get?
I can't get rid of the
thing. Scan Josh's. You'll be all right.
Yeah, all you have to do is go to joshvips.com/DSCR. joshvips.com/DSCR. And there's a Google form there. When you submit that form, it goes to our whole team, and then we get to work on shopping for options for you. And just very transparently, that's what we were doing prior to going live here. Is we were chatting back and forth on a couple of different. We've got a blanket opportunity or a blanket DSCR loan that we're shopping. We've got a second mortgage, a rate and term refi, and one just came in this morning.
We have three others to
right. A cash out refi. He owns it free and clear. And he's just trying to pull out some cash to consolidate debt, right? So when you submit the information on that form, at that link, joshvips.com/DSCR, you'll get a confirmation, and then we get to work on shopping for you. We just ask for 2 to 3 business days. We try to have options for you sooner than that, but just bear with us if not, because we're working to find the best potential options. And sometimes it takes us a little bit just to get, we have to go and actually manually shop all of these with the different lenders that we work with. And we're happy to do it, but we just need some time. Mike asks, does the gross rent qualify your income, or is it 75% of the gross rent?
It's gross rent. So what Mike is referring to is when you're doing a mortgage and you're renting out a property, right? Let's say you're moving from one house to another and you're renting out your current residence. We could use that rent as on like FHA or conventional. We could use that rent for income, but we can only use 75% of it because we haven't claimed taxes on it yet. This is not that. Those are two totally separate programs. This is a DSCR program, which is a whole different program. They'll use the gross, 100% of the gross amount.
Yeah.
So when we're qualifying or they're doing a 1-to-1 ratio, it's based off gross. It's not based off a 75% amount. And again, you don't necessarily need a 1-to-1. We do properties down to 0.75 very, very regularly, and in situation, no ratio loans.
Yeah.
Right.
Yeah.
Maybe the 1007 from the appraiser you disagree with, right? Maybe it does rent for a lot more because I'm sorry to say it, but appraiser's not right all the time. So
Sure. Yeah.
at times there are
They're humans just like all of us.
yes. So
okay, so there's that. If you have a deal, you want us to shop for you, or you want to get with one of us and create some content that you can use and leverage however you see fit. But the last thing I want to mention is if you are a licensed agent or you're already a licensed LO, number one, we have a dual license program for licensed real estate agents who can get their mortgage license and start to earn revenue from mortgage activity. Mike Stearns, who asked that question, is in underway for that program. Or if you are already licensed LO and you're looking for a better or new opportunity where you can have access to many, literally hundreds of wholesale lenders and thousands of private, commercial, hard money lenders, we are very aggressively looking to hire and partner with both self-generating LOs and also folks that might be looking to join a team and get some more
training,
hands-on help.
hands-on mentorship and learning
Yep.
how to truly originate in this market.
Yep. So I'm going to pop our contact information back on the screen here. You can get back with either one of us and chat about what that looks like, how those opportunities work, compensation. If dual licensing is something that you're interested in, we can tell you, give you the information. Here are the exact steps to follow and in what order. And what that looks like once you do get your license and how we proceed from there. We would love to chat with you about that. I've been having some wonderful conversations with real estate agents who are doing just that. In fact, we've had 2 people come on to our Relo program in the last 2 weeks. We had one last week, one this week, and I had a great LO from South Carolina that just made the switch here to NEXA that Jordan was so helpful to yesterday. He's got loans to submit, and that's a good thing, right? He's trying to figure out how we do that here at NEXA, and Jordan was there to help and support him. So, Jordan, thank you for your time and expertise on these DSCR loans, and we will be back next week, 1 Eastern on Tuesday, with another topic that we'll do a deep dive on that you can then take to proactively look for how you can help and serve more clients or potential clients in your market. And if you need anything, please don't hesitate to reach out. We're happy to chat and help any way we can. Thanks, Jordan.
Thanks so much.